Hello traders. So I'm gonna upload this midweek video in addition to my normal Sunday night portfolio reviews, purely because I've done quite a few trades this week, so I thought I'd log them as they're pretty new, and then I can review how they've done come Sunday night and every week thereafter. It was a pretty good day in the market yesterday for selling cash secure puts. Bit of a kind of stable reddish day for a lot of the stocks that I have on my watch list, that I watch for small retracements or red days to bump up the cash secure put premiums before I jump onto them. So first one I did yesterday was Novo Nordisk. This has been, it's one of the big farmers, and it's been beaten up quite heavily over recent times. You can see it's a proper major downtrend from highs of what we got here, 148, right down to where we are now, down at the 60-58 range. So I sold 56 strike cash secured put for 24th of October expiry, so 27 delta at the time, and it was a pretty nice premium of 2.75% on capital employed, which is a 33% annualized return. So why am I happy with owning NVO at 56? So fundamentally, I believe NVO is undervalued at these levels. Even with the lowered guidance, the stock trades at about 14 times next year's earning, I think it is. And if we look at the closest kind of comparable competitor, which is Eli Lilly, they're trading at 30 times next year's earning. And if you have a dig in about NVO's balance sheet, it's showing about a 44% net operating margin, generating piles of free cash flow. It's strong in the diabetes and weight management areas, which in our Western world are not health issues that are going to go away overnight. So we've got plenty of business coming in for those drugs. And they've got a new incoming CEO, Mike Doustar, I believe his name is. He's got a solid track record of running international big operations if you check him out. So in a nutshell, my personal belief, and it's my personal belief, so I can be wrong obviously, is NVO is cheaper than any other major pharma company at the moment, while it is delivering profitability and buckets of free cash flow. So I'm pretty happy if I get assigned at 56 on this one. I think it is going to be coming back. I think the bottom has been reached, as you see down here, around 45. And since then, we have been heading up. Technicals, my 56 strike is close on what could kind of flimsily be called a resistance type support level here, around the 56, 57 mark, and it is kind of following that 20-day moving average in the last month or so. So a bit of a speculative play, this one, but when you look into the fundamentals of Novo Nordisk, I am convinced it's undervalued, and therefore if I'm assigned, I'm going to be happy at 56, especially for the over 2% premium I'm getting for the 30-day trade. Plan for this one would be to take 50% profit if I can get it in under 15 days. If not, I'll be shooting for the 80 to 90%. If I am challenged, happy to take assignment. If I can't, roll out and down for a credit, and we'll just flip it to covered calls. The premiums on the call side look alright at the lower deltas, the higher deltas. the lower deltas. So yeah, that's the plan for NVO. PAAS. So this is a bit of a attempt for me to diversify the portfolio. I don't have any precious metals, commodity type stocks in the current portfolio, so I went for PAS. So I went for the 35 strike, 24th of October expiry. It was a 22 delta at the time. That got me a bit less than my normal 2% targeted. I came in at 1.86 for 30 days, 22% annualized. It's been quite a red day today, but if we ignore that, I took the trade here. My reasoning at the time was the 35 strike was resistance back here at the start of September, broke through, tested it again here middle of September, bounced off, and has remained, well, take out today actually, so I'm recording this after markets closed. Not a great day. We'll see what happens tomorrow. My thinking was it's followed the 20-day moving average really quite well. Even if you go back further, it does seem to correlate with the 20-day moving average. So my thinking was if it came back for a bit of a retracement, this 20-day moving average at 35.40 would act as support. So it looks like we might going to be testing this theory in the next couple of days. We will see. But either way, it's more of a diversification play for me. If I get assigned, and obviously Pan American silver is not a commodity in itself, it's more of a proxy for price of silver, but it would give me some exposure to the precious metals, which tend to be used for hedging the market by a lot of people, a lot of institutions, which is probably why we're at pretty high level at the moment. You know, the SPY has been on an absolute tear for ages. It's all-time high. So people must be getting pretty nervous about an inevitable turnaround, correction, and a hedging a little bit, just like me. So that's the plan for that one. We'll see how that works out. SoFi. SoFi is an old friend of mine. It's one of my favourites. It's a strong, profitable growth company, good customer loyalty, good stickiness as they call it. I've traded this a lot over the last year, and they say the trend is your friend. So if we have a good look at this has just been a crazy upward move since the lows of April. It's been skyrocketing. It does periodically come back and test the 20-day moving average, but it always seems to bounce up off it. We are quite extended above that right now. So well, today you can see we've had much the same as PAAS, bit of a red day. But again, my thinking for the 26 strike was this is as low as I could go, still get my 2%. Actually for this it was a 19 delta at the time, and that was a 2.42% trade for 30 days, or about 29% annualized, and we're a good way off the stock price, even taking into account today's drop. This would be another one. I think we might be testing my theory on the 20-day moving average support in the next couple of days, but I could even see it dropping briefly down, perhaps to my strike, where this last level of what was resistance, it was tested once, twice, came down, hit the 20-day moving average, tested it again, broke through, and has not come back since. So we'll see what happens there. On to the next trade. That was HIMS. So HIMS is one I play with fairly regularly. I reserve a portion of my overall portfolio for high IV plays in strong bull markets like the one we've got at the moment. And HIMS has a huge implied volatility, which makes cash secured put premiums extremely juicy. Of course, it gets this high IV as it's an extremely volatile stock. And it jumps around a lot on a daily basis. If you look at the chart here, you see massive ups and downs. These are daily candles. It is very news bound, so you'll get massive drops out with earning seasons where you'd normally expect to see gaps like this, and it's very unpredictable. But for that, you get paid very well for taking the risk. So at the time I made this trade back here, we were up at the 56-ish level. And I was able to get a 45 strike on a 14 delta for 2.4% for 30 days, about 28.8% annualized. Now if you look at this strike level, it is at a well-defined support resistance zone. It's been tested a lot, so here it was resistance before it became support, tested it several times before making a jump. It collapsed down through it here, came up again, kind of hovered around it, and is now back up again above all moving averages. If I'm wrong and it shoots back down through these moving averages, which HIMS can do in a heartbeat, then we do have the next level right down here at the 41 level, and that is a much stronger level of support that's been tested before. So plan with HIMS, same as the other ones, I'll take 50% if I can get it before 15 days. If not, I'll shoot for 80 to 90%. If I'm challenged, which is a common occurrence with HIMS in my previous trades, to be fair, I will look to roll out and down, which can be a lot easier with HIMS because of its high IV. It is a lot easier to roll as the premiums are a lot higher. If not, we'll take assignment and we'll do covered calls. It's not at even recent highs. It's not at recent lows. It's just kind of trundling around in the middle here. So yeah, we'll see what happens with HIMS. Soxal, my good friend Soxal. You will remember from previous videos that Soxal has been a bit of a problem child for me. Let's just get it on the screen. So it was one of those trades where I was assigned almost a year ago, assigned at a high level, first at the 50 mark, then at the 43 mark, way back in time. And I've since been doing covered calls from, back in, or even further back, October last year. So we followed it all the way down, and we've attempted to follow it all the way back up again with covered calls. Now, for those of you that are a bit unsure, Soxal is a leveraged ETF. It's for semiconductors, and it moves fast in both directions. So I got caught with deep in the money covered calls that I've been struggling to roll up and out. So Soxal for me really is kind of a worst case scenario trade that if I'm not careful and I'm called away or assigned, I will lock in a realised loss, which I'm not looking to do. So I adjusted my positions as the cover calls that I had. If you look back at last week's video, I had the cover calls down at 30, way down here. So Soxal had moved $5 in the money on me. So I rolled out and up the cover calls by 1 month and $5 a share. I paid for that by rolling out and up the cash secured puts that I had down at 16 by 4 months and $4 a share. So yeah, I've increased the strike price of the covered calls, which would increase the proceeds by $2,000 if my 200 shares get called away, which would still be below my cost base, but a lot closer than it was. However, to pay for that, I did take on additional risk, about an extra $800 by increasing the strike price of the cash secured puts by $4 a share. So it's important to note here the focus was on increasing the strike price of the calls, not receiving the highest possible premium. To me, a higher strike price on the call side is much more valuable if Soxol continues to climb, which it looks quite happy it's going to be doing. So I need to monitor this trade closely. I will aim to roll the strike price up further if needed. And my goal is not to be assigned here at 35, although that is quite a big risk with these leveraged ETFs. So my goal is to roll this up eventually above the cost basis of 36.83 that you can see up here, and then continue to get it up back to hopefully where I was assigned. Long road to go for that. And if it's called away just at my cost basis, I won't have a loss on the trade, but it will effectively mean I've traded Soxol for over a year for free, which I'm not eager to do. So I need to get above the cost basis and then keep going to lock in or realise the profit and finally get myself out of this trade. I'll keep using cash secure puts to pay for the call strike increases, but as an alternative, I could have increased the call strike price for a net debit, which is smaller than the strike increase, so it would still be a profitable overall return as long as Soxol continues to climb. If it didn't and it reversed, I'm effectively increasing my cost basis for no gain. So pluses and minuses on using cash secured puts to pay for call increases. You have to be bullish on the underlying before you do that. So my goal is not to get any additional cash secured puts assigned, as I already own 200 shares. If the strike of 20 does get challenged, which of course would mean the calls would be pretty much worthless, I would attempt to roll out and down those puts. But in the absolute worst case, and the shares do get assigned, it would at least lower the combined cost basis quite considerably. I'm not a fan of the averaging down strategy. It's just, in my mind, it just feels like putting more money into a falling knife, and it's not a strategy that I usually employ. I'd be certainly more hesitant on an individual stock. ETFs, a little bit safer, less likely they're going to go bankrupt. Although Soxol, again, 3 times leveraged, who knows. So yeah, that's the plan for Soxol. So for the time being, I've got 2 covered calls, 20th of Feb 26, that are at the 35 strike, which is a considerable improvement on where I was this time last week with Soxol. Paid for by 2 much further out in time cash secure puts, 15th of May 2026 at the 20 level. That's how far I had to go to get a decent credit. For all of this messing around, it was 52 cent credit overall, so $52 in total, which is not bad. It's still a credit for one of the trades in my portfolio that's gone massively against me. Yeah, so that's where we are at the moment. So what's that? 4 new trades and a trade repair midweek for week 39. I will see you on Sunday night for the usual roundup of the entire portfolio, after today being quite a red day, actually. Okay, well, stay healthy, stay profitable. I'll see you on Sunday.